Deduction for mortgage insurance on residence, on your personal primary residence, if the loan was taken out between January 1st, 2007 and December 31st, 2010. Of note for shareholders and partnerships that need to file for sub-S corps and partnerships, last year there was a new penalty for those failing to file their K-1s. That was $89 in 2009, and that is per month. In 2010, they have raised that to $195 per shareholder or per partner per month. So be on guard against that one. Try to get those in filed on time. The first-time home buyer credit, we've all, I think, aware of that since 2007. It came into effect. That was good for up to $7,500. That was repayable over a 15-year period, at $500 a year. So that payback period is beginning. For those who received the tax refund or the tax credit of $8,000, which is not needed to be repaid, that amount is still in effect for purchases prior to May 1st, 2010, or if you had a sealed contract or a signed contract that actually closed by September 30th of 2010, you can qualify for that $8,000 new home buyer credit. You must not have had a home in the prior, or a primary residence, owned a home in the prior 3 years to qualify for that. You do not qualify for the $8,000 credit if you purchased it from a family member or if the seller provides down payment assistance. The new home buyer credit is phased out for singles between $125,000 and $145,000, $125,000, $145,000, and married filing joint $225,000 to $245,000. There's been a ton of fraud in this with the new home buyer credits. They had something like 49 inmates claiming the same home for the $8,000 tax credit. They were not married. So it wasn't like, their spouse purchased a new home and they were just unfortunately incarcerated. So the IRS is really cracking down on it. I've had a number of requests from the IRS to provide additional supporting documents. What they are asking that you do is attach a copy of your closing statement, the HUD-1, to your return. And it also helps if you can provide any additional information along the lines of like a driver's license with the new address on it. Anything to support it. Love the IRS. They love that. The other requirement is you do need to be 18 years of age at time of closing on the new house. There's also a existing home buyer credit for up to $6,500 that applies for people who did priorly own a home for 5 years of the last 8 years. A good example of the people who would have qualified for this would be empty nesters moving down to a smaller house. You are not required in that instance to sell the old home. The maximum credit is the $6,500 for married filing joint, $3,250 for married filing single. The same tax period or time period applies as the new home buyer's credit, and if you are in the military, there is an extended period in place. Residential home gain exclusion. These are prorated for periods after 2008 where it's not your personal residence. Say you take a rental property and convert it to your home. The depreciation that was taken is recaptured as ordinary income. If it was a vacation home, you must have held it and used it as your primary residence for 5 years. And on another note, credit card reporting. All these PayPal transactions we see, those types of things, eBay, this economy that's going on, millions of dollars that are not being reported to the government. The government said enough of that. Starting in 2011, credit card companies, including PayPal, will have to report to the IRS if receipts are greater than $20,000 and they process more than 200 transactions. A lot of foreclosures on homes going on these days. they have put into something called the Mortgage Forgiveness Debt Relief Act. What this does is it is allowing you, mortgage forgiveness or foreclosure tax on your principal residence up to $2 million of debt forgiveness can be excluded. If it is on your primary home, it must be acquisition debt. So if you are upside down on your home, your mortgage is higher than your home value, and you get one of those nasty 1099-Cs from the bank, which is cancellation of debt, you can get that. That becomes income, but with your qualified primary residence, up to $2 million of debt forgiveness can be written off. That $2 million cannot include any refinancing costs or credit card debt. And always a good point of note, see your attorney if you're coming up with questions about this. Taxable gain qualifies for exclusion if 2 out of 5 years met. You have to have lived in the house for 2 out of 5 years, which is just the definition of a primary residence. There's something called Form 982 that applies to other forgiveness of debt. This is what you file if you have credit card forgiveness of debt. If you settle a credit card for 31 cents on the dollar, you have 69 cents per dollar. You will be getting that nasty 1099-C form, which qualifies as reportable income. If you were insolvent immediately before that point of the forgiveness, the cancellation of debt, you do not owe the money. You do not recognize the forgiveness of debt as income to the extent of the insolvency. Anyone here Bernie Madoff? There were a large number of complaints about that. People were wondering what to do with their worthless securities. Were these theft losses? How did they determine that? People did not want to just take billions of dollars in capital losses. You would only be able to take up to $3,000 a year. So what they've done is they have made it so that we can deduct theft losses or worthless securities. What is required, you must have a note from your broker that shows that that stock has ceased trading. And we also, the IRS also requires a news article that the firm is liquidating and that the liabilities of the firm exceed assets. To be defined as a theft loss, it occurs when the appropriation, or misappropriation is probably a better word, of funds with the intent to deprive investors. The key word there is there must be intent. Just because your broker or agent is incompetent, that is not theft.
Sure feels like it. It's just as bad.
Yeah, it doesn't make it any better, does it? Special gain exclusion on sale of small business stock for less than $50 million. Currently, there's 50% gain exclusion on small business stock sales, 100% gain exclusion on small business stock sale if the stock was issued, and I don't know which special interest got this pushed through, but between 9/27/2010 and before January 1st, 2011. So someone had a congressman or two's ear to get that pushed through. So if someone issued stock during that period, you can sell that for a gain and deduct, or not have to pay out 100% of that gain. The BIG tax. BIG stands for built-in gain. This comes about from conversions of C Corps to S Corps. You used to have to wait 10 years so that you didn't have to pick up the built-in gains on sale. That has been shortened to a 5-year holding period for tax years beginning in 2011. COBRA benefits. Lots of unemployment. People have lost their jobs. For people with involuntary separation between September 1st, 2008 and May 31st, 2010, the employee pays 35% of their COBRA costs, and the government will reimburse the employer for the other 65%. For those of you who don't know what COBRA is, That's the means of extending your health insurance. It's the cost of that can be up to 100% of your premium with an additional 2% tacked on for administration fees. Above the line deductions. These are deductions that are allowed in arriving at or for adjusted gross income. These deductions include half of your self-employment tax, self-employed retirement plan contributions, $4,000 of qualified tuition and expenses deductions. This phases out between $130,000 and $160,000, and it's deductions of up to $4,000 or $2,000 to phase out. You cannot take that deduction for education and also take the education credits. No double dipping there. Teacher expenses. We expect this to go through this year. Teachers are allowed to deduct for AGI $250. They must have receipts for things they purchase for in-class reviews. Health savings accounts. These are a dying breed with what's going on. But you can deduct the amounts in your health savings accounts for arriving at AGI. The reason I say they're a dying breed is you're required to have a health savings account. You need a high deductible health plan. The new laws that are coming through are mandating certain benefits be provided. And what happens is with that, it is making it so that you cannot have the structure for a high deductible health plan. So I think we're going to see health savings accounts phased out. Self-employed health insurance, also for partners and greater than 2% sub-S owners. That is deductible in arriving at AGI. Up to $2,500 in student loan interest is deductible. Job-based moving costs, if the greater than 50-mile test is met. For all you thespians out there, there's performers' expenses are deductible in arriving at AGI. Alimony by the person paying is deductible in arriving at AGI. It is ordinary income to the person receiving it. And for any of you who do jury duty, any surrender jury pay is deductible for arriving at AGI.
If you did it 5 days, it's $100.
You cannot claim a dependent unless they earn less than $3,650. Dependent, we always think of children, but in this day and age with our parents getting older, we need to take care of them sometimes too. So, Lenny's all in support of that. So, if the elder parent or the child makes less than $3,650, you can claim them as a dependent. Unless, also, if they are a child under the age of 19 or a full-time student under the age of 23, you can also claim them as a dependent. We had some energy-efficient credits for new purchases. This applied to purchases of insulation, windows, doors, roofs, heating and cooling equipment in your primary residence. I have a lot of clients ask me or tell me that they've done this. Vacation homes, second houses, that type of thing does not apply. It must be your primary residence.